The global trade landscape is shifting, with significant implications for economies worldwide, and not subtly. The United States, under the Donald Trump administration, has introduced a series of measures aimed at curbing China's economic influence, has taken an aggressive stance against China, citing concerns over trade imbalances, intellectual property theft, and national security, implementing tariffs exceeding 104% on all Chinese imports. This represents a dramatic escalation of the ongoing trade war between the world's two largest economies, affecting a wide range of industries from technology to agriculture. China has retaliated naturally, raising tariffs on U.S. goods to 84%. This move targets key American exports such as soybeans, automobiles, and electronics. This tit-for-tat exchange has sent shockwaves through global markets, causing fluctuations in stock prices and investor uncertainty, leaving many wondering, what sparked this economic conflict and how long will it last? Experts are divided, with some predicting a prolonged standoff while others hope for a negotiated resolution. The U.S. argues these tariffs are necessary to counteract what it perceives as unfair trade practices by China, including intellectual property theft, forced technology transfers, and state subsidies that give Chinese companies an unfair advantage. China's dominance in critical sectors like technology, manufacturing, and increasingly clean energy has raised alarm bells in Washington. The rapid advancements in these areas have positioned China as a formidable competitor on the global stage, challenging U.S. economic and technological leadership. There's a growing concern that reliance on China for essential goods could pose a national security risk in the future. This dependency could potentially be exploited in geopolitical conflicts, making the U.S. vulnerable to supply chain disruptions and economic coercion. Furthermore, domestic political pressure, particularly from industries claiming to be hurt by Chinese competition, has fueled the push for protectionist measures. These industries argue that without tariffs, they cannot compete with the lower production costs and aggressive market strategies of Chinese firms, leading to job losses and economic decline in the U.S. The U.S. strategy goes beyond just tariffs. It encompasses a comprehensive plan to bolster domestic industries and reduce economic vulnerabilities. It's pouring billions into revitalizing American manufacturing, aiming to create jobs and enhance the country's industrial base, particularly in key areas like semiconductors, which are crucial for modern electronics and national security. Electric vehicle batteries and clean energy technologies, aiming to lead the global transition to sustainable energy. Simultaneously, the U.S. is strengthening trade alliances with countries like India, Vietnam, and Mexico to build a more resilient economic network, seeking to diversify supply chains and reduce dependence on China, ensuring stability in global trade. This multi-pronged approach aims to pressure China on multiple fronts, leveraging economic, technological, and diplomatic tools, forcing it to adopt fairer trade practices, or so the theory goes, while protecting American interests and promoting global economic stability. While the U.S. government argues these tariffs are necessary to protect domestic industries and reduce the trade deficit, the reality is, they come at a significant cost to various sectors of the economy. American consumers are facing higher prices on a range of goods, from electronics and appliances to clothing and toys, as retailers pass on the increased costs of imported goods. The tariffs have also disrupted global supply chains, leading to delays and shortages. This has affected everything from manufacturing to retail, causing a ripple effect that impacts the availability of products on store shelves. Businesses, too, are feeling the pinch, facing higher input costs and uncertainty in the global market. Many companies are struggling to absorb these costs, leading to reduced profit margins and, in some cases, layoffs and closures. The long-term consequences of this trade war are still unfolding, but one thing is certain: there will be winners and losers, and the global economy is in for a bumpy ride. Investors are wary, and market volatility has increased as businesses and consumers alike navigate this uncertain landscape. As the trade war continues, experts are divided on its future trajectory. Some analysts predict a prolonged standoff, while others foresee a potential resolution in the near future. Some believe that the U.S. and China will eventually reach a compromise, easing tariffs and restoring more stable trade relations. This could lead to renewed economic cooperation and growth for both nations. Others argue that the conflict will persist, driven by deeper geopolitical tensions and competition for global dominance. Issues such as technological supremacy and military influence in regions like the South China Sea add layers of complexity to the trade dispute. Regardless of the outcome, the world is watching closely, as the decisions made by these two superpowers will shape the global economic landscape for years to come. The ripple effects of their actions will impact international markets, trade policies, and economic alliances worldwide. The United States holds several advantages over China in the ongoing trade war, which have been pivotal in shaping the dynamics of this economic conflict. Firstly, the U.S. has a more diversified economy, with strong sectors in technology, finance, and services. This diversification allows the U.S. to mitigate risks and capitalize on various growth opportunities across different industries. This diversification provides a buffer against economic shocks, ensuring that a downturn in one sector does not cripple the entire economy. It also fosters resilience and adaptability in the face of global economic changes. Secondly, the U.S. dollar remains the world's primary reserve currency, giving the U.S. significant leverage in global financial markets. This status allows the U.S. to influence global trade and finance, providing a strategic advantage in international negotiations. Additionally, the U.S. has a robust legal and regulatory framework that supports innovation and entrepreneurship. This framework encourages business growth and attracts global talent, fostering a competitive and dynamic economic environment. These factors combined give the U.S. a strategic edge in the long-term economic competition with China, positioning it to maintain and enhance its economic leadership on the global stage. The question of whether China will lose the trade war or if it knows what it's doing is a complex one. Many factors come into play, including economic policies, global alliances, and internal market dynamics. On one hand, China has a massive manufacturing base, which allows it to produce goods at a lower cost. This extensive infrastructure includes advanced technology and a skilled workforce, making it a formidable player in global manufacturing. This manufacturing prowess gives China a significant edge in terms of production capacity and efficiency. The ability to scale production quickly and maintain high-quality standards is a key advantage in the competitive global market. Additionally, China has a large and rapidly growing consumer market, providing a substantial domestic demand for its products. This burgeoning middle class is increasingly seeking higher quality goods, further driving economic growth. This internal market strength means that even amid global trade tensions, China's economy can rely on its own consumers to sustain growth. The resilience of this market is a buffer against external economic pressures. Furthermore, China's government has the ability to implement long-term economic strategies and policies, which can provide stability and direction for its industries. These policies often focus on innovation, infrastructure, and sustainable development. Unlike the U.S., where policy can shift with each election cycle, China's centralized governance allows it to maintain consistent economic policies over the long term. This consistency helps businesses plan for the future with greater confidence. These factors combined suggest that China knows what it's doing and has a strategic advantage in the long-term economic competition with the United States. The ability to adapt and innovate within a stable policy framework is a significant strength. The balance of power in global trade is complex and multifaceted, and while the U.S. has its strengths, China's unique advantages cannot be underestimated. The interplay of these strengths will shape the future of international trade. As the trade war continues to evolve, it will be crucial to watch how these advantages play out on the global stage, shaping the future of international trade and economic relations. The outcomes will have far-reaching implications for economies worldwide. Despite the ongoing trade war, China continues to receive support from several countries, showcasing its resilience and strategic alliances in the global arena. Nations like Russia, Pakistan, and various African countries have maintained strong economic and political ties with China, driven by mutual benefits and long-term strategic goals. However, the question remains whether any of these countries will reconsider their support for China, especially in light of increasing global pressures and shifting alliances. If nations begin to back down, it could significantly impact China's Belt and Road Initiative and its influence in infrastructure projects across Asia, Africa, and Europe, potentially stalling numerous development projects. The implications of such a shift could reshape the future of international trade and economic alliances, altering the global landscape in unforeseen ways and possibly leading to a new era of economic realignment. Additionally, China might leverage its relationships with these supportive nations to act as intermediaries, facilitating trade with the USA indirectly, thereby circumventing some of the trade barriers imposed by the tariffs. The 145% tariff on Chinese imports has significant implications for various companies, affecting their bottom lines and operational strategies. This drastic increase in tariffs is forcing companies to rethink their supply chains and consider alternative manufacturing locations. Major tech giants like Apple, which rely heavily on Chinese manufacturing, are facing increased production costs. This not only impacts their profit margins, but also leads to potential delays in product launches and higher prices for consumers. The company is exploring options to diversify its manufacturing base to mitigate these risks. Retailers such as Walmart and Target, which import a large volume of goods from China, are also feeling the pinch. leading to higher prices for consumers. These increased costs are being passed down to shoppers, potentially reducing consumer spending and affecting overall sales performance. The automotive industry, including companies like General Motors and Ford, is experiencing disruptions in their supply chains, affecting production and sales. These disruptions could lead to longer wait times for new vehicles and increased costs for parts, which may ultimately be reflected in higher car prices. As for the future, experts are divided. Some predict that the tariffs will lead to a renegotiation of trade terms, while others believe that the economic strain could force companies to innovate and find new ways to cut costs. Some believe the USA might back down to ease economic pressures, while others argue that the tariffs could be raised further to push China into more favorable trade terms. The ongoing negotiations are complex, with both sides weighing the potential benefits and drawbacks of their positions. The outcome remains uncertain, but the impact on these companies is undeniable. Businesses are grappling with increased uncertainty, which affects their planning and investment decisions. From increased costs to disrupted supply chains, the tariffs are creating a ripple effect that extends far beyond the borders of the two nations involved. This disruption is causing delays and shortages, which can have a cascading effect on global trade and economic stability. The stakes are high, and the global economic landscape is watching closely. Investors and policymakers around the world are monitoring the situation, as the outcome could have far-reaching implications for international trade and economic growth. Will the pressure lead to a resolution, or will it further entrench the conflict? The political and economic ramifications of these tariffs are complex, and the path forward remains unclear. Only time will tell, but one thing is clear: the ramifications are far-reaching and complex. The long-term effects on global trade, economic policies and industry practices will be significant and multifaceted. In the USA, an 84% tariff increase would heavily impact major industries such as technology and automotive. Companies like Tesla, Intel, and General Electric would face significant challenges, potentially disrupting their operations and market reach. These industries are critical to the U.S. economy, and any disruptions could have widespread consequences for employment and economic growth. As the trade war intensifies, a critical question emerges: why isn't China selling U.S. bonds? This question has puzzled many economists and policymakers given the escalating tensions and the potential leverage China holds. With over $1 trillion in U.S. Treasury securities, China holds significant leverage. This massive holding makes China the largest foreign creditor to the United States, giving it a unique position in the global financial system. But rather than offloading these assets, China has opted to hold on to them. This decision has sparked debates among financial experts about China's long-term strategy and its implications for global markets. So what is China waiting for? Analysts suggest that China might be waiting for a more favorable economic or political climate before making any drastic moves. The decision to hold U.S. bonds is strategic. By maintaining its holdings, China can avoid triggering a financial crisis that could have far-reaching consequences. Selling them could destabilize global financial markets, causing the value of the bonds to plummet and hurting China's own investments. This potential market instability is a significant deterrent for China. Additionally, a sudden sell-off could strengthen the U.S. dollar, making American exports more expensive and less competitive globally, ironically counteracting the trade war's goals. This would undermine the very objectives China aims to achieve through the trade war. But what if China did start selling its U.S. bonds? This hypothetical scenario has been the subject of numerous economic models and simulations. Would it help or worsen the U.S. economy? The immediate effects might be mixed, with some sectors benefiting while others suffer. Initially, the U.S. might benefit from a lower dollar, boosting exports. This could provide a temporary economic boost, particularly for American manufacturers and exporters. However, the long-term effects could be detrimental. A prolonged period of financial instability could lead to a loss of investor confidence and a slowdown in economic growth. A massive sell-off would likely increase U.S. interest rates, making borrowing more expensive for American consumers and businesses. This could lead to higher mortgage rates, increased credit card interest, and more costly business loans. This could lead to a slowdown in economic growth and potentially trigger a recession. The ripple effects could be felt across various sectors, from retail to real estate. Moreover, the move could erode investor confidence in U.S. financial stability, causing a ripple effect across global markets. This loss of confidence could lead to a flight of capital from U.S. assets, further exacerbating the economic downturn. The United States might find it harder to finance its debt, leading to higher borrowing costs and budgetary constraints. This could force the government to cut spending on essential services and infrastructure projects. In essence, China's bond strategy is a double-edged sword. While it provides a form of economic leverage, it also carries significant risks for both China and the global economy. While it provides a form of economic leverage, using it could also backfire, causing significant disruptions in both economies. The interconnected nature of global markets means that any drastic move could have unintended consequences. As the trade war rages on, this financial chess game continues to add layers of complexity to an already intricate situation. Each move is carefully calculated, with both sides weighing the potential risks and rewards. The world watches closely, as any drastic move could reshape the global economic landscape. The stakes are high, and the potential for significant shifts in economic power dynamics is ever present. Will China play this card, or will it hold back, waiting for a more opportune moment? The decision could hinge on a variety of factors, including domestic economic conditions and international political developments. The stakes couldn't be higher, and the consequences more profound. The outcome of this financial standoff could have lasting implications for the global economy, influencing everything from trade policies to international relations. As the trade war between China and the United States intensifies, both nations are compelled to look beyond their traditional trading partners. The imposition of tariffs has disrupted long-standing trade routes, forcing both countries to adapt quickly. But could these challenges also present new opportunities? For China, the tariffs are a catalyst for diversifying its trade portfolio. Faced with increased costs of exporting to the US, China is turning its attention to untapped markets in Asia, Africa, and Europe. These regions offer immense potential for growth. In Asia, China's Belt and Road Initiative is already paving the way for stronger trade relations. Africa, with its rapidly growing economies and abundant natural resources, presents a promising frontier. Europe, despite its own economic challenges, remains a lucrative market for Chinese goods. By forging new trade alliances and strengthening existing ones, China could mitigate the impact of US tariffs and secure its position as a global trade powerhouse. Similarly, the United States is not standing still. The tariffs have prompted American businesses to seek new opportunities in regions like South America and Southeast Asia. South America, with its rich agricultural and mineral resources, offers a valuable alternative to Chinese imports. Southeast Asia, with its burgeoning middle class and dynamic economies, presents a fertile ground for American exports. By diversifying its trade partners, the U.S. aims to reduce its dependence on China and create a more balanced and resilient trade network. This shift in trade dynamics is not without challenges. Establishing new trade relationships takes time and requires significant investment in infrastructure and logistics. Both nations will need to navigate complex political landscapes and address potential trade barriers. However, the potential rewards are substantial. By opening new markets, both China and the U.S. could create more robust and diversified economies, less vulnerable to the whims of any single trading partner. In this chapter, we will explore the potential new markets that could emerge for both nations as a result of the ongoing trade tensions. We will examine the opportunities and challenges they face, and the strategies they are employing to seize these new opportunities. The trade war may have disrupted the status quo, but it also presents a chance to reshape the global trade landscape in ways that could benefit both China and the United States in the long run. As the world watches this economic chess game unfold, one thing is clear: the trade war is not just a conflict, but also a catalyst for change. And in this new era of global trade, both China and the United States have the opportunity to redefine their roles and secure their positions as leaders in the global economy.